Real estate has been sold to you as the ultimate passive income machine. And for a long time, I believed it too. But there's a number most real estate investors never talk about. The actual time it takes before a property puts a single dollar in your pocket. Not the projected return, not the appreciation. The first real payment. When I ran the comparison against dividend stocks, the gap shocked me. And it's going to shock you too. Because the strategy most people are sleeping on doesn't require a down payment, a landlord license, or a 3 a.m. maintenance call. It just requires knowing where to look. Stay with me, because the number I'm about to show you changes how you think about passive income forever. Let me introduce you to Sarah. She's 28, makes $75,000 a year as a marketing manager, and has exactly $25,000 saved up. Sarah's goal is simple: generate $500 per month in passive income as fast as possible. She's been told real estate is the way, but she's also heard dividend stocks can work. The question is, which gets her to that $500 monthly target first? Here's what's fascinating, and what nobody talks about. Sarah could theoretically buy a rental property today. With her $25,000 as a down payment, she could finance a $125,000 property. The numbers look good on paper. Rent comes in at $1,200 per month. After the mortgage payment of $750, she's looking at $450 gross monthly cash flow. That's almost her goal right there. But Sarah's about to learn something that changes everything. If you want to see exactly how this plays out and why the real numbers shocked even me, subscribe right now. I break down these exact scenarios every Tuesday and Friday, showing you the real math behind building passive income streams that actually work. The problem with Sarah's real estate plan isn't the monthly cash flow projection. It's everything that happens before she sees that first payment. Let's walk through Sarah's real timeline. Month 1. Sarah finds a property. She makes an offer. It gets accepted, but now she needs inspections, appraisals, and loan approval. Even in a fast market, this takes 30 to 45 days minimum. Sarah's at day 45 with zero passive income. Month 2. Closing happens. Sarah officially owns the property. But it's vacant. She needs to find tenants. Even with a property management company, tenant screening and move-in takes another 3 to 4 weeks. We're now at day 75. Still zero passive income. Month 3. Sarah's first tenant moves in. Finally, rent starts coming in. But wait, there's a security deposit to hold, first month's rent to collect, and the property management company takes their 10% cut. Sarah's actual net income this month? Maybe $350 after all fees and holding costs? And here's what really gets ignored. Sarah put $25,000 down, plus another $3,000 in closing costs, plus another $2,000 in immediate repairs and tenant prep. Her total upfront investment? $30,000. To generate maybe $350 net in month 3. But that's just the beginning of Sarah's real estate journey. Month 4 brings the first maintenance call. The HVAC system needs a $400 repair. Month 5, the tenant reports a leaky faucet. Another $150. Month 6, the property management company increases their fee structure, and Sarah's looking at higher monthly costs. By month 6, Sarah's averaging about $275 per month in actual passive income. Not the $450 she projected, and certainly not the $500 she was targeting. Her real estate investment will eventually cash flow better, but right now, 6 months in, she's nowhere near her goal. And let's look at what happens if Sarah takes that same $30,000 and builds a dividend portfolio instead. This is where things get interesting, and where there's something about dividend timing that most people completely miss. Sarah starts with $30,000, and she's targeting $500 monthly, which means she needs $6,000 annually in dividends. That's a 20% yield on her capital. Sounds impossible? Not if you know where to look. But here's the twist that changes everything about this comparison, and it has to do with something called ex-dividend dates that most investors ignore completely. Sarah decides to split her $30,000 across several high-yielding dividend stocks. She allocates $10,000 to Realty Income Corporation, trading under the ticker symbol O. This real estate investment trust pays monthly dividends and currently yields around 6.5% annually. That's about $54 per month from this position alone. Another $10,000 goes into Energy Transfer LP, ticker symbol ET. This master limited partnership yields approximately 9.8% annually, paying quarterly. That's about $245 every 3 months, or roughly $82 monthly. Her final $10,000 gets allocated to AGNC Investment Corp., ticker AGNC. This mortgage REIT yields approximately 12.8% annually with monthly payments. That's about $106 per month. Let's do Sarah's dividend math. 54 plus 82 plus 106 equals $242 monthly. She's not at 500 yet, but she's getting decent cash flow immediately. And here's the key difference. Sarah starts receiving dividend payments within 30 to 90 days of her initial investment, not 3 to 6 months like real estate. But Sarah gets smart. She takes those dividend payments and reinvests them. This is where compound growth accelerates everything. After 12 months of reinvesting, her positions have grown. The realty income position, now worth about $10,600, generates $57 monthly. Energy transfer, now at $10,800, generates about $88 monthly. A GNC at $10,700 generates about $113 monthly. Total monthly dividend income after 1 year of reinvestment, $258. Sarah's getting closer to her $500 target, and she's doing it without tenant calls, property taxes, or maintenance emergencies. But here's where most dividend investors stop. They think they need to keep reinvesting everything. Sarah realizes she can accelerate her timeline by adding fresh capital while reinvesting dividends. She commits to investing another $500 monthly from her salary into her dividend portfolio. By month 18, Sarah's portfolio has grown to around $45,000 in value. Her monthly dividend income? Approximately $375. She's 3/4 of the way to her $500 goal, and she's never had to deal with a single property management headache. Now let's check back on Sarah's real estate investment at the same 18-month mark. The property is finally generating consistent cash flow. After accounting for vacancy periods, maintenance, property management fees, and the occasional major repair, Sarah's averaging about $325 monthly net income. Slightly less than her dividend portfolio and with significantly more hassle. But wait, there's something about this comparison that I haven't told you yet. Something that completely changes which strategy wins, and it's not what you think. We've covered a lot of ground here. Sarah's real estate investment is producing $325 monthly after 18 months. Her dividend portfolio is generating $375 monthly. The dividend strategy seems to be winning, both in timeline and current income. Sarah's dividend portfolio has something real estate can't match: liquidity and flexibility. If Sarah needs capital quickly, she can sell dividend stocks within days. Try selling a rental property quickly without taking a massive loss. More importantly, Sarah's dividend portfolio can scale without her active involvement. Every dividend payment that gets reinvested automatically compounds her returns. She doesn't need to qualify for new mortgages, find new properties, or manage additional tenants. The scaling happens automatically. Let's project forward to year 3 for both strategies. Sarah's real estate investment, assuming she leverages her equity to buy a second property, could potentially generate $700 to $800 monthly from 2 properties. But she's also doubled her headaches, her risk exposure, and her active involvement time. Sarah's dividend portfolio, assuming she continues adding $500 monthly plus reinvesting all dividends, could reach $75,000 in value by year 3. At an average yield of 7.5%, that's generating about $470 monthly in passive dividend income. She's almost at her original $500 goal from just one investment strategy. But the real question isn't which strategy produces more income in year 3. It's which strategy gets Sarah to her $500 monthly goal faster while requiring less active management. Let's run the final numbers. For Sarah to reach $500 monthly from real estate, She needs her properties to generate about $700 gross monthly cash flow to net $500 after all expenses. With average rent prices in her market, that means owning properties worth approximately $250,000 total. Even with leverage, she'd need about $50,000 in down payments and equity. For Sarah to reach $500 monthly from dividends, she needs about $80,000 invested at an average 6.3% yield. At her current savings and investment rate, she reaches this in approximately 4 years. The real estate path could potentially get there faster if everything goes perfectly. No major repairs, no extended vacancies, no problem tenants. But the dividend path gets there more predictably, with less stress, and with complete liquidity if life circumstances change. Here's what surprised me most in running these numbers. The actual speed difference isn't as dramatic as most people think. Both strategies can get Sarah to $500 monthly within 3 to 5 years. The bigger difference is in the experience of getting there. Sarah's real estate journey involves constant decision-making, problem-solving, and active management. Her dividend journey involves research up front, then mostly patience and consistency. The real estate path could produce higher returns long-term, but the dividend path produces more predictable returns with less volatility. The winner depends entirely on Sarah's personality, risk tolerance, and available time. If Sarah wants to be actively involved in building her passive income and doesn't mind the occasional 3 a.m. maintenance call, real estate could work. If Sarah wants truly passive income that doesn't require her ongoing attention, dividends are the clear winner. If Sarah chooses dividends, she needs to focus on high-quality companies with sustainable yields and consistent payment histories. If she chooses real estate, she needs to account for all the hidden costs and time investments that aren't immediately obvious. For those of you building your own $500 monthly passive income target, the path you choose matters less than understanding the real timeline and requirements for each strategy. Both work. Both have trade-offs. The question is which trade-offs you're willing to accept. If you want to dive deeper into the dividend strategy and see exactly how to build consistent monthly income from dividend stocks, check out my video on the $1,000 dividend strategy nobody talks about. I break down the specific stocks and timing strategies that can accelerate your dividend income timeline. You can find it on your screen